A few months ago I made a video in which I said that used car prices might be on their way down. All the signs were there. Wholesale prices saw their first drop, the demand frenzy was over and we saw signs of inventory recovery. So did prices actually decrease? Well, yes, but after that they surged to a new high. At least the wholesale prices did. The picture looks different for the retail prices, so let's see what happened in the market and why the prices are not yet on their way down. Manheim prepared again a slide deck with the latest figures on the car market, and in here we find the wholesale vehicle value index. We have the date on the horizontal axis and the price index for the wholesale prices on the vertical index. Historically, prices developed quite stable with a few peaks and bottoms. We can see a drop in 2008 during the financial crisis and also in the beginning of the pandemic. There simply was a lot of uncertainty in the market back then. However, prices quickly recovered as demand increased and supply decreased. After this price surge, we could see a drop of 1.3% in June of this year, and it was after this drop that I said we might be close to a market pivot. And as you can see, prices did indeed decrease, and they did so more severely than in the previous period. Yet, September came in with a bang, as prices increased by 5.3% compared to previous month and by 27% compared to last year. And with these numbers it resulted in a new price record. However, there might be something brewing together beneath these numbers. These are namely the wholesale prices, and not the retail prices what most of you will be paying. So let's have a look at those. Over here we have the week numbers on the horizontal axis and the price index on the vertical axis. And you can see 4 lines. The solid blue one shows the development of the 2021 retail prices, and the grey solid one the development of the 2021 wholesale prices. The dotted lines show the 2020 development. Now in this graph something interesting is happening. You can see for example that during last year, retail prices followed wholesale prices. When the grey dotted line went down, the blue dotted line followed, and when the grey line went up, the blue line followed. The retail price development is just a dampened version of the wholesale price development, and it lags with around 6 weeks. This is a pattern which is quite natural, and a pattern which usually holds. Usually. You can see that in the beginning of this year, retail prices followed the increase in the wholesale prices. When I made the previous video, we could see a small decrease in the wholesale prices. So the expectation was that the retail prices would also come down, and as you can see, they did. Let it be only marginally. However, you can see that during August and September, wholesale prices increased rapidly, but that retail prices didn't follow. Normally there is a lag of around 6 weeks, so one could argue that the retail price adjustment is just a bit slow this time. Yet, it might be so that retail prices won't adjust fully to the wholesale level because the spread between the two was already large when the increase in the wholesale prices started. We can see for example the same in the beginning of 2020 when retail prices didn't fully adjust to the wholesale prices. So why exactly might this be the case? Let's first look a bit deeper into the wholesale prices and then into the retail prices. The experts from Manheim indicated that there might be 2 things going on with the wholesale prices over here. First of all, dealers might be confident and perhaps a bit overconfident. They feel that demand was high in the last few months and that they can pay higher auction prices and pass this off to retail prices. If we look at the sales conversion trends for the auctions, we see a lot of this confidence. These trends display for 2019, 2020 and 2021 what percentage of the cars at auctions are sold. Typically, the higher the percentage, the higher the dealer demand. If we look at the green line, which shows the 2021 sale conversion rate, we can see that this increased a lot compared to Q2 and that it sits far above what is typical for this time of the year. Yet at the same time, we also need to take into account that auction supply sources are extremely low. Supply from off-lease vehicles is only at 15% of their normal volume, as many lease vehicles are subject to high equity positions, and also supply from the rental market is extremely low as it sits at 40% of its normal number. Now alternatively, so besides dealers just feeling confident and perhaps overconfident, they might simply be preparing for spring season, in which retail is typically strong, fueled by the tax refunds. They know that auction supply is low, so they could be buying more now for slightly higher prices with the aim to have enough supply in the beginning of next year. It's simply very difficult to find out what their motives are by looking at the data. But let's now switch gears and have a look at the retail side. But before we do so, if you like this video, please click on the like button down below as it really helps to support the channel. Thank you. If we look at the retail sales, then we see a remarkable picture. Retail sales namely decreased drastically. Over here we can see again the weeks of the year on the horizontal axis and the retail sales compared to 2019 on the vertical axis. The orange lines show the retail sales for the used cars and the blue lines for the new cars. So, for example, this solid orange line shows the development of the retail sales for used cars during 2021 compared to 2019. The dotted orange one shows the same but for 2020. We can see, for example, a large drop in sales in the beginning of the pandemic. Retail sales were 60% lower than in 2019. Now if we go back to 2021, so the solid lines, then we can see that retail sales peaked in the spring and since then decreased. We can also see that the decrease is especially strong for the new cars, but this makes sense as there are hardly any new cars for sale. Now this strong decrease in the used retail sales might be the result of the large price increase what we just saw. Cars might be simply too expensive right now, and many people are aware of the high prices. If we look at the Vehicle Affordability Index, where we have the date on the horizontal axis and the number of median weeks of income needed to purchase an average vehicle on the vertical axis, we can see that it sits at an all-time high. In other words, for an average buyer, cars were never this expensive. The elasticity might be simply out of the price right now. And after all of those graphs, let's do a little recap. We saw an increase in the wholesale prices, which can either be fueled by dealer confidence or be based on preparatory actions for spring. Meanwhile, on the retail side, we saw a more or less stable development in retail prices, which might result from the low demand. And all of this comes beautifully together in the inventory levels. Over here we have the day supply development for the new and the used cars. And the day supply basically tells a company how long it takes on average to sell their inventory. If we look first at the new cars, then we can see that nothing happened compared to Q2. Supply is still extremely limited, so the cars sell very fast. For the used cars, the story is different. After a dip in the beginning of the year, the day supply increased and right now it's almost back at 2019 levels. So this means that used cars are no longer selling like hotcakes and that dealers have sufficient stock levels. And both of these conclusions are supported by the previous data. So what does all of this then mean for future prices and when can we finally start to see a significant turn in the price trend? If we look at the bigger picture, so demand and supply, then we still have a supply constraint when it comes to new cars. Not even the car industry itself knows when it will be solved, but various reports note that the situation should become less stringent in the second half of 2022 and should be solved in 2023. On the demand side we can see a bit of a slowdown, but it's unlikely that demand will plummet. Additionally, demand is usually strong during tax refund season. Experts from Mannheim therefore expect a small price increase of around 2 to 3% before the end of the year and the first sign of a price decrease after the spring. Now, like I already mentioned a few times in other videos, I don't think that there will be a market crash. Rather, I think that prices will adjust gradually. Supply of new cars will only increase very slow and demand is not likely to plummet. So since both supply and demand move slowly, it's unlikely that prices will move fast. But when they start to move, I think that it's unlikely that they will move to their pre-pandemic levels. Let me show you why. Over here we have the index development over time for the wholesale used vehicle prices and the new vehicle prices. Historically, we can see that new vehicles increased slightly more as they tend to follow inflation plus a certain margin. We can also see that both have their seasonal patterns. More recently though, we can see a sharp increase in the wholesale prices, which we have seen now a few times in this video. Yet, since the beginning of this year, new vehicles also saw a large increase. And this of course results from the scarcity in that market. However, I think that this also means that used car prices won't fall to pre-pandemic levels. Car manufacturers noticed that customers are willing to pay a higher price than what they were asking before the pandemic. And this shows in their profit margins. For example, BMW and Daimler saw a profit margin of around 8.5% in 2018, while they are currently at 16 and 12%. And these manufacturers are of course not stupid. They already announced that also when the chip shortage problem is solved, they plan to limit supply to keep prices high. BMW even believes that when customers need to wait for their cars because it's purposefully undersupplied, it adds to the buying experience. Now if we go back to the used cars, then this also means that in the long term supply for used cars will be smaller and that prices will lay at a higher level. And with that, let's wrap up and conclude. We saw that there's a divergence in the market between wholesale and retail prices, and that there might be very good reasons for this. On the one side, we have the dealers who were buying aggressively during last quarter and drove up wholesale prices. On the other hand, we have a weakening retail market as retail sales continue to decline. And it might be that dealers are simply preparing for the seasonal increase in demand during the beginning of next year. But this situation also reminds me a bit of the bullwhip effect, what we for example saw in the chip sector. A full explanation of this effect you can find by clicking on the video over here. But in short, it means that small fluctuations in demand cause large and delayed fluctuations on the supply side. So perhaps dealers are anticipating a further increase in demand, while this demand doesn't seem to exist anymore. But this is simply my own hypothesis and something which might affect prices in the short term. Long term, it's now especially the supply of new cars which is key. According to industry experts, we should see supply increases around halfway of 2022. And with that we arrive at the end of this video. Now if you enjoyed this video, please remember to support the channel by clicking on the like button down below. Also, don't forget that you can find detailed depreciation analysis on my channel for a large variety of cars. You can find, for example, analysis on the 911 market and the Corvette C8 market. If you can't find the car you're looking for, please comment the name of that car down below in the comment section. Once there are enough requests for a certain car, I will make a video about it. As always, thank you for watching and I hope to see you next week for a new video.